Okay, in our last session, we started with chapter 3. So I want to just back up and just review just slightly, and then I want to do a problem on our rental, and then we will continue on and hopefully be able to finish this chapter in this session, which I'm pretty sure we should be able to finish this chapter. We started off the chapter 3 just to do a little review before we work on a problem. Is that we started off talking about our rental income, and we began by talking about what type of rental may you have. You may have a rental that's considered primarily for personal purposes, where you have just a little incidental days, and none of that income is going to be taxable to you, and you can take your mortgage and interest on your Schedule A. Or you may have a rental that is deemed to be primarily rental use. In that case, it's really rental, and you just have a couple of personal days, not to exceed 14 days or 10% of the rental days. And in that instance, you want to allocate your expenses between the rental and the personal days, and then you can deduct your expenses, including a loss on Schedule E. And then you may have a rental that's considered primarily rental personal split, kind of a dual purpose. And in that instance, you still allocate the difference between the two, but you cannot take a loss. You're not allowed to take a loss on that particular rental. And in that instance, you can only deduct your expenses up to your income. So we started there. And so what I want to do just briefly is I want to do a problem, just to we didn't get a chance to do that. So I want to do a problem. And so if you look in the back of chapter 3, and we're going to look at number 2, which appears on page 3-34. Okay, so let's look at that problem, number 2, which appears on page 3-34. And let's just do that quickly, and then just so you can kind of get an idea of how that works. We have Sherry. She rents her vacation home for 6 months and lives in it for 6 months. During that year, her gross rental income during the year was $4,000. The real estate taxes is $950, and then the interest on the home mortgage was $3,000. Annual utilities and maintenance was $1,800, and the depreciation was $4,500. So with hers being 50-50, even without going to the calculations, that is going to be a dual, a rental personal split, because her rented days her rental days were more than 15 days, and her personal days were the greater of 14 or 14 days or 10%. So we know that's going to be that split. So let's look at what we need to do for this problem. And this is problem, you can see this is problem number 2, or question 2, that's on page 3-34. That's on page 3-34. So they tell us that she had rental income for the year of $4,000. So rental income was $4,000. And because this is a dual property, then she is only going to be able to take expenses up to her income. She's only going to be able to take expenses up to her income. And remember, this is 50-50, so we have to consider that as we allocate the expenses. So the expenses that she's able to deduct, or that they're able to deduct, is we have to deduct them in that order. We first start with the real estate taxes, and that's the first. And the real estate taxes were $950. Okay, and for the real estate taxes, because this was half personal, half rental, we can only take half of them. So we're only going to take half of those. And then also we're going to look at the rental portion for the interest. And the interest on the home was $3,000. And so we can only take half of those. Okay, so when we're looking at they're telling us the order in which we have to take them in. We started off with $4,000. She gets to deduct half of the taxes and then half of the interest. And so that leaves her $2,025 of income in which she can deduct expenses against. The next thing in the order, they tell us to take the other items, the utilities, maintenance, anything else that you may have before depreciation. And in this instance, she had utilities and maintenance expenses of $1,800. So we had utilities and maintenance expenses of $1,800. Okay, but she's only going to get half of that, once again, because half of it's personal, half of it's business. So we only want to take half of that. And that gets us down to $1,125 left of income in which she can deduct expenses against. And the depreciation, which is what's left, the depreciation on it is $4,500. Okay, technically, she would be able to take half of that, which is which would be $2,250. But we don't have enough income left to take that, so we're only going to take what's left because we cannot take a loss. We cannot take a loss. So net income ends up being zero. We deducted depreciation of $1,125. We deducted utilities and maintenance of $900, interest of $1,500, and we deducted taxes of $475. So those are expenses that we're allowed to deduct up to the income. So you cannot take more than the income because that was a split. Now, had this been a piece of property that was not a split, and we could have taken all, had it been primarily rental, we could have taken all the applicable, and let's just say it was still $2,050. We could have taken all the applicable depreciation, and therefore we would have been able to take a loss of $1,125. So that is the difference between on our rental. So I just kind of wanted to back up and do a problem together, so that you kind of understand the calculations and how they work for this when we're dealing with our rental. So that's where we started on in our last session. Started talking about our rental, and then we went over our passive loss rules. We went over the real estate being a passive activity and the possibility of taking up to a $25,000 loss there. And then we ended up by looking at our bad debts. So that's where we want to start, basically where we left off there, where they're talking about our bad debts, So let's get you on the correct page that we're on, and then we'll pick up at that point. At the bottom of page 3-8, we start bad debts. Basically, when we're talking about businesses, just briefly, we're really talking about uncollectible accounts receivables. And we spoke about the situation where it has to be a situation that you've taken the income on it in order to be able to take the bad debt on it. Then we looked at business bad debts, and basically a debt from a trade or a business is going to get an ordinary income deduction, and it's going to be taken against ordinary income on Schedule C. It's going to be taken against ordinary income on Schedule C. And so now we want to pick up at our non-business bad debt. These are our personal debts. And so basically these particular debts, all these other bad, and let me blow that up so you can see that. All these other bad debts, these are going to be taken or considered short-term capital losses. They're going to be considered short-term capital losses, and they're going to be limited to a $3,000 loss each year against ordinary income. So the most loss that I can take and offset my regular income is going to be $3,000. If I have more than that, any unused amount can be carried forward. Okay, and this is all done on Schedule D. It's going to be all done on Schedule D. It's going to be done on Schedule D. So kind of like what I'm referring to, let me get a little space, is that if I had this loss of $10,000, okay, kind of as an example, let's say I had a loss of $10,000, and then I also had, I can only take, I'm sorry, if I had a bad debt of $10,000, I can only take $3,000 of that. The other $7,000 is going to have to be carried forward. Okay, so that's the most I can take, is the $3,000. The other $7,000 is going to have to be carried forward. Okay, that's our bad debt. In this class, we do not cover inventory, so we will not cover that as you're looking through your text. And then they deal with net operating losses, which that is not covered in this basic income tax class either. And so now I want to pick up, and we want to deal with the rest of our session, this particular class period, is we want to deal with retirements. We want to deal with retirements. How do we deal with IRAs, individual retirement accounts? And that starts on page 315. So we want to pick up there, and that's what we want to cover and look at. Okay. IRAs, or individual retirement accounts. There's two types. There's a traditional IRA, and then there is a Roth IRA. Okay, so we want to look at both of those. The traditional IRA and then the popular Roth IRA. Traditional IRAs are deductible. You make deductible contributions, meaning when I put money in, it is a deduction for me. But when I take money out, my distributions are taxable. So you have deductible contributions and taxable distributions for a regular IRA. Okay? For a Roth IRA, you have non-deductible contributions. So when I'm making contributions to my Roth IRA, I cannot deduct them. And my distributions are not taxable. So I have non-taxable distributions. Okay. So when we're looking at an IRA, we have, if it's traditional, all my, not all, and we'll look at, there's some limits. My contributions are going to be deductible, meaning I get to deduct them from income. And my distributions are going to be taxable. So when I begin to draw, there's a portion that's going to be taxable. The Roth, on the other hand, as I make contributions to it, are not going to be deductible, but my distributions will not be taxable. Okay? And then the earnings on both of these, are not taxable. So current earnings So basically, as you leave the money in there and it earns money, those current earnings are not taxable. So current earnings are not taxable. Okay. So let's begin to focus in on, first starting with our contributions to traditional IRAs, First of all, for those contributions to a Roth or traditional IRA, you have until April the 15th. In this case, for a 2008 return, you would have until April the 15th of 2009 to make that contribution. So you're not tied by the end of the year. You have until April the 15th in order to make that contribution. For a traditional IRA, the maximum contribution amount is going to be the lesser of 100% of earned income, meaning all my income, if that's the lesser number, the lesser of 100% of earned income, or $5,000. Okay, and if you're married filing jointly, it could possibly be $10,000, which would be $5 a piece. And so you can take, if you can take that additional $5,000 for the spouse. Okay, we're going to look at when those rules apply. So if we can end up taking that additional $5,000, technically you can get up to $10,000 on a return. And then they have what they call some catch-up. They have what they call catch-up contributions. You can make an additional $1,000 in catch-up contributions. And this is only for taxpayers and spouses who are age 50 and over. Okay, so if you're 50 and over, I can even make an additional, so it can be up to $6,000 per person for that purpose. Okay, so there's a possibility that a portion or your contributions could not be not be deductible. Generally, the contributions to an IRA is deductible, but it depends on whether you're already participating in a plan. It depends on a number of things as to whether it's going to be deductible or end up being non-deductible. So if we look on page 3-16 and we look at the chart at the top of that page, and we're going to look at a couple of examples as well when it comes to that. So there's a possibility that this $5,000 that I can take, maybe all my $5,000 may not be deductible. Okay, so let's look at the chart at the top of page 316. That chart is titled 2008 AGI Phase Out Ranges for Traditional IRAs. So we're talking about traditional IRAs. So they have a column for the taxpayer, and then they have a column for the phase out range. So if you are single and you're filing head of household and you're not a plan participant, so that means that I am not participating in the plan at work. I'm not already in a retirement type plan. There's no phase out, so therefore I can contribute the $5,000 and get the full $5,000 deduction. If I am single or head of household and I am in an active plan, so I do also have a plan at work. If my income is between $53,000 and $63,000, there's a possibility that I will not get a portion. There's going to be a portion of mine phased out. If my income is over $63,000, I won't get to take the deduction at all. Doesn't mean I can't make the contribution. It just means it's not going to be deductible. If I'm married, filing joint, and both are in an active plan, meaning me and my spouse both, and if our incomes is between $85,000 and $105,000, there's going to be a phase out of the amount of deductions we can get. If it's over $105,000, we're not going to be able to get that deduction. And so I won't read the rest of the chart to you, but that's how the chart works. Okay. It also tells us, note, and we're going to look at an example of this because they have 3 good examples in this particular textbook. It says when one spouse is an active participant in a retirement plan and the other is not. So if we got one in, one out, 2 separate income limitations apply. One is going to apply to the one who is not. The other one's going to apply to the one who is. The active participant spouse may make a full deductible IRA contribution as long as the income is not between $85,000 and $105,000, which is the phase-out range. The spouse who had no active participant, the spouse who wasn't actively participating in the plan, then they're going to get the full deduction, okay, unless the joint income is higher than $159,000 and $169,000. So even though we may use separate qualifications, the income amount that we're going to use is going to be the joint, them combined together. So even though we may end up doing that, okay, so that is your traditional one. So let's write a note and then we'll look at the exercise. So, but due to income limitations, so it's going to be based off your income. That's what they're looking at. Due to income limitations, Okay. All of the 5,000, and I know it's possibly could be 6,000 or 10,000. All of the 5,000 maximum amount may not be deductible. Okay, so let's start by looking at the example, the first example that's on page 316. Let's look at that example. Ed, age 31, is single and is covered by a retirement plan. If his modified adjusted gross income is $59,000, Ed's maximum deductible traditional IRA that he can deduct is $2,000. It's $2,000. And the way they got that, let me go ahead and show that, even though it's in the book. But Ed, he had income of $59,000. Okay, he was single. Okay, and he was also already covered by a retirement plan. So single active plan participant, the range is $53,000 to $63,000. And so because he falls in the middle of that, then he's going to get a portion of it. If his income was over here, then he wouldn't get to deduct any of that. Okay, so what we do is we take the upper limit, which is $63,000, minus Ed's income. Okay, and that gives us $4,000. So he has $4,000, as they say, left in the range to deal with, and so that's how you kind of determine how much we're going to give him, the phase out. And then we divide it by 10,000. The 10,000 comes from 53,000 and 63,000. There's 10,000 in the range. So there's $10,000 in the range, and that's how they get the $10,000. So we take 4,000 divided by 10,000, and then we multiply it by 5,000. We multiply it by 5,000. So that represents the allowed deduction portion. So he's going to end up getting a $2,000 IRA deduction. Okay. Now he can't contribute the full 5,000. Nothing says that he can't. He can contribute the full 5,000, but he's only going to get a deduction for the 2,000. So 40%. It ends up he's able to get a 40% deduction. Okay. Let's also look at the example that's at the top of page 317. This is when you have two different people. I like this example as well. Paul and Lucy are married and are both 36 years old. Lucy is covered by a plan and earns $57,000. So we got Lucy. So I'm visual. I have to see these things. She's covered. She's covered by a plan and she earns $57,000. Paul is not covered. So Paul is our not covered person. Okay. Paul is not covered by a retirement plan. He earns $57,000. So we have Lucy's $57,000, and we have Paul's $50,000. So their total income is $107,000. So when we're looking at the charts, that's what we want to look at, is the 107. Lucy cannot make a deductible contribution because if we look, married, filing jointly, and we have one active participant. Okay, when we have one active participant, then the active participant spouse, if you look at the top of page 316, the active participating spouse, the phase out range is between 85,000 and 105,000. So given that, if Lucy makes a $5,000 contribution, it is not deductible. Okay? So Lucy cannot deduct hers because it falls on the outer range. It falls on the outer range. Okay? If you look for the non-active participating spouse, the range for Paul is going to be between 159, so it's higher, and 169. So since their income is not in the range or the phase out range, that means Paul gets to make a $5,000 deduction, and it's going to be deductible. Okay, so in this case, one spouse's is not deductible and the other spouse's is. So because one is a participant, one is not, we look at two different line items on the chart and two different qualifications. So it's very well that one could be and one could not. Okay, now one thing we want to pick up there and talk about is we want to talk about the Roth IRA. So even though in this case Lucy could not make a deductible contribution to a traditional IRA, there's a possibility that she could make a contribution, because remember, they're not deductible anyway, in a Roth IRA. So she may choose to make a contribution to a Roth IRA. Okay, so if we look at the Roth IRA, they begin to talk about that. And a Roth IRA, as far as the contribution amounts, they are the same as the traditional IRA. So they're going to be the same as the traditional IRA. And so these rules are going to apply. So they apply for a traditional IRA, and they are also the same for a Roth IRA. So same. So the contributions are going to be the same. Now the difference is that the phase out, a little different. If we look at the bottom of page 315, so you want to look on page 315 for the phase out. Okay, 2008 phase out ranges for Roth IRAs. And with a Roth IRA, if you are an active plan participant or not, versus not, doesn't matter. So that's not what we're looking at here. We're just simply looking at income amounts. So single or head of household, the phase out ranges between 101 and 116. And for married, filing jointly, the phase out ranges between 159 and 169. Okay, so it doesn't matter if you're an active plan participant or not. So let's look at an example. They have an example that I want to look at and kind of walk you through on page 316. And it's the last one that deals with the Roth. It says, Ann, who is 36, would like to contribute $5,000 to her Roth IRA. However, her AGI is 110. So we got Ann. She got AGI of 110. So when we look at our AGI phase out range for and she is single, so the range is between 101 and 116 for a single person. So her number falls in between that range, means that it's phased out. Just like with the other one, if it's over 116, that means she gets no deduction. If her AGI is less than 101, that means she will get the full deduction. Okay, so she wants to make a $5,000 contribution, and what we want to do is a similar calculation when we did the phase out before. We want to take the upper limit of 116 and subtract from it her income, the 110. And when we do that, we get $6,000. Then we want to divide that $6,000 by 15,000, similar to what we did on here, 101 to 116. There's a fixed $15,000 range. So that's how we get our bottom number. And so then we want to multiply that times our $5,000, and it just happens to be 2,000. That's because that comes up to be 40% again. So that's how she would determine for her Roth IRA how much of her contribution she can make, and that is at the bottom of page 315. So if you go back to Lucy, if we go back to our example up here, Remember, they had, let me show you this. Remember Lucy, $5,000, not deductible. Their total AGI was 107. And so if we look at the Mary Fallon jointly range, theirs would be 159 to 169. So she would be able to make that full $5,000 contribution to an IRA. So she would be able to make the full $5,000 contribution to an IRA, which would be good. Okay. So let's continue. Now those deal with the contributions to an IRA, or contributions to an IRA. We want to look at now, how do we handle the distributions, the money that comes out? How do we handle the money that comes out of an IRA? Okay. So when we're talking about distributions, we're talking about withdrawals. When we're talking about distributions, we're talking about withdrawals that we take out or that are coming out. Okay. For a traditional IRA, those withdrawals are taxable as ordinary income. So basically, they're taxed at your regular ordinary income rate. Okay. They could very well be subject to a 10% penalty. And you can't take them out, or to keep you from being subject to that penalty, along at 59 and a half. Okay. Now there are some situations that you can take it out penalty free before you're 59 and a half. And so those you want to look at. So for penalty free withdrawals that you make before you're 59 and a half, we want to look at page 317 for those. We want to look at page 317 at the bottom. If you're disabled, they give us a couple of them. Using a special level payment option. If you're using the withdrawal for medical expenses in excess of 7.5% of your AGI. If the recipients of at least 12 weeks of unemployment compensation. So this is very important as our economy finds ourselves in a situation where we may have a number of people unemployed. And to the extent that they are paying medical insurance premiums for their dependents. So just keep that in mind. Paying the cost of higher education, including tuition, fees, books, room and board for the taxpayers, their spouse, children, or grandchildren. So if you're using it for that purpose. Or a withdrawal of up to $10,000 for first-time home buyers. So you could also use that as well for first-time home buyers. So you can very well take it out penalty-free before you reach the 59 and a half. You're still going to have to pay ordinary income tax on it. So that you doesn't alleviate that, but what you do is you alleviate the penalty. Okay, and one last note on those is that those withdrawals, you can't make them before 59 and a half, but you have to begin to make them by the time you reach 70 and a half. So minimum annual distributions are going to be required at 70 and a half. I think I said 79, but 70 and a half. So can't make it before 59 and a half. If you reach 70 and a half and you haven't started withdrawing money out of those IRAs, you need to make those minimum annual distributions, and there's some charts and some calculations that goes on with that, what IRS considers to be minimum. Okay. Next, what about our withdrawals or our distributions from a Roth IRA? These withdrawals are tax-free, and they're tax-free after 5 years. Okay. And if it's not a 5 year, let's look at 1 through 4. That's going to be on page 318. So let's look at that. 3-18. Okay. For your Roth here, it tells us that you have a 5-year holding period on your Roth if any of the following requirements are satisfied. So hold it for 5 years. You can withdraw if these items are done. The distribution is made on or after in which you're 59 and a half, so we still have that age limit on there. The difference is that you only have a 5-year waiting. The distributions is made to a beneficiary are after a participant's death. So if it's being distributed because of the death of the individual, the participant becomes disabled, or the distribution is used to pay for qualified first-time home buyer expenses. So once again, you can use it for a home buyer expense. They have an example here on this page I want to look at. Bob establishes a Roth IRA at the age of 50 and contributes the maximum each year for 10 years. The account is now worth $61,000, consisting of $35,000 of non-deductible contributions. So that means he put $35,000 of his own money, so it's non-deductible, and $26,000 of earnings that have not been taxed. So over those 10 years, $26,000 of earnings. Okay. Get back to where Bob may withdraw the $61,000 tax-free from the Roth IRA because he is over 59 and a half, because he started at 50, now he's 60, and has met the 5-year holding period requirement. So he's met those. And the thing about that is that it grew tax-free, so he's not having to pay tax on $26,000 worth of earnings, which is huge. If he would have put that same amount of money in a traditional IRA, he would have got the deductions for those contributions, but he would have paid tax on those withdrawals on that earnings piece. He would have had to pay tax on that. Okay. So basically, let's say that I didn't meet that. Let's say that I'm not 59 and a half and I withdraw that money. Okay. So the taxable situation with that one. So it's going to be taxable if the requirements are not met. So it's going to be taxable if the requirements are not met. And basically the way it works, the return of capital, meaning my portion that I put in that I didn't get a deduction for, I'm going to get it back tax-free. So I'm not going to have to worry about still paying tax on that. But the earnings is going to be taxable to me. The earnings is going to be taxable to me. So I lose that tax-free part of the earnings. I'm going to lose that tax-free part of the earnings. If we keep looking back at that example on page 318, they give us another example. Assume the same facts in the above, except that Bob is only the age 56 and he receives distribution of $10,000. Remember, he contributed starting at 50, and so now he's 56 and he receives a $10,000 distribution. He has put in some money. In that instance, after 10 years, he had put in $35,000 and had earnings of 26. So situation is that now he's 56 and he receives a distribution of $10,000. Assumes that his adjusted basis for the Roth is $12,000, meaning contributions made of $2,000 for 6 years. So let's assume he made $2,000 contributions for 6 years. Okay, the distribution is tax-free and his adjusted basis is reduced to $2,000. So because he had put in 12, he got a distribution of 10. All that's tax-free. That's just like getting his money back. That's getting his money back. So that would be tax-free. Okay. A couple things I want to point out before we move away from our Roth. If you turn to page 317 in your book, they talk about taxpayers transferring Roth traditional accounts to Roth. It tells us taxpayers with AGI not more than $100,000 may benefit from the rule allowing conversions of regular IRAs into Roth IRAs. Okay, although that conversion is going to be subject to current income taxes, because remember those distributions from a traditional IRA are going to be taxable. Taxpayers with certain factors in favor, such as many years to retirement, maybe they have a lot more years to retirement to go, a low current tax bracket, maybe currently I'm in a very low tax bracket, maybe because of children, because of my mortgage on my home. So I have a pretty low tax bracket to where a lot of times when people retire, they have no more mortgage deduction, the children are gone. It's sometimes, even though their income is lower, but sometimes their tax bracket is higher due to the fact they don't have as many deductions anymore. And so they go on and say, you know, due to low current tax bracket or high expected tax bracket at retirement, may wish to make the conversion, because then when they begin to take their money out of the Roth, that money is not going to be taxable to them when they're at the higher rate. Okay. Now keep in mind, when I make the conversion now, I'm going to have to go ahead and pay tax on that. It says also taxpayers with negative taxable income due to large personal deductions may wish to convert enough of their regular IRAs to Roth IRAs to bring taxable income to zero. So instead of it being negative, maybe they'll make a contribution to bring it to zero. This way, the conversion can be done with no tax costs, since deductions which would otherwise be lost because of the negative are offset now by the IRA income. So they can use that IRA income to bring up their income. So therefore, instead of having negative taxable income, they can at least have a zero taxable income. Then it goes on to tell us for the years 2010 and beyond, the rule that required taxpayers to have 100,000 or less AGI for this conversion that I just read from a regular IRA to a Roth IRA account has been eliminated. So for the tax years 2010 and beyond, okay, that $100,000 limitation is gone. So Congress expects that many high-income taxpayers will take the advantage of this opportunity to pay income tax due up front on those conversions. So excellent opportunity to consider, just something to consider as you begin to look at your Roth, maybe setting up a Roth versus a traditional. So just know there are some IRS benefits out there for that purpose. There's some IRS benefits out there for that purpose. Okay, on page 319, they talk about a KEG plan or a simplified employee pension plan. Okay, these plans are plans that mostly we're looking at self-employed people setting up plans, okay, for retirement for their purposes. So when we're talking about a KEG plan, we're looking at self-employed people. So if I'm self-employed, I very much want to set up this tax-deferred plan. So tax-deferred retirement plan. Okay, so we're looking at self-employed tax-deferred retirement plan. Okay, and they call these KEG plans. Okay, now for these plans, the contributions are going to be limited to, meaning the amount that me as a self-employed person can put in there is going to be limited to the lesser of 20% of my net earned income, or $46,000. Okay, so my contributions are going to be limited to the lesser of either 20% of my net earned income or $46,000. Okay, they have also what they call set plans. Okay, and these are like simplified employee pension plans, or there are IRAs as well. There are IRAs as well. The contributions into these plans are going to be the same as our KEG plans, and so 20% of net earned income and $46,000. Okay, now we want to be careful. We're going to have some penalties as well with these plans. So to avoid penalties, you want to make sure that your distributions from these plans are not before 59 and a half, and you want to make sure you're making minimum distributions at 70 and a half. So those same type rules apply when we're dealing with those particular plans as well. Those same type rules apply when we're dealing with those particular plans. So you want to make sure that you're not taking out before 59 and a half, and that at 70 and a half, you make sure you're making minimum distributions from those plans. Okay, we have about 5 minutes left. And so I just kind of want to touch on, we still in our beginning of our next session, we'll have a little bit left to cover in here. On 3.8, they talk about qualified retirement plans. including 401ks, which are also important plans. So I want to look at that. So let me just kind of briefly introduce the 401ks. Basically, employers, this is where employers is going to receive deductions for any contributions they make that are made on behalf of the employee. Okay, and as long as it is a qualified plan, it's got to be a qualified plan. So when we're looking at those rules, and those qualified plan rules on page 3-20. Okay, and so as we look at that, we're going to be looking at a defined contribution plan versus a defined benefit plan when we look at 401ks. And then we're going to look at how much can I contribute to a 401k. A lot of times some employers will match those contributions, and that's what I mean by the deductions that they can get. And so what we'll do is we just have like a page or two of chapter 3, and then we're going to go ahead and pick up with chapter 5. We're going to look at itemized deductions. We will look at itemized deductions, Schedule A deductions. So we'll wrap up these last 2 pages in chapter 3, not cover chapter 4, and then we're going to pick up chapter 5, which deals with itemized deductions. So make sure you're reading chapters and make sure you're doing multiple choice questions at the end of the chapter. You should be working on your multiple choice questions for chapter 3, and therefore ready to turn those in when we complete the chapter. That's it.